Hello and welcome to the Kearney Group July 2023 investment market updates. My name is Matt England. I'm the Chief Operating Officer here at Kearney Group, and I'm joined today by Will Curtain and by Andrew McKenzie. Will is the Portfolio Manager at Milford Asset Management for the Australian Absolute Growth Fund, the Milford Dynamic Fund, and is co-portfolio manager of the Milford Active Growth Fund, a very busy man. Will's been with Milford Asset Management since 2010, and prior to that was actually a professional triathlete, something I'm sure we'll dig into a little bit as we look at whether what we're facing into is a bit of a sprint in terms of interest rate changes, or whether we're in for the long haul and a bit of a grind. But most importantly, Will is the proud father of a third child, and so life at home in New Zealand is a little bit chaotic. Will, welcome to this, and thanks so much for taking the time to join Andrew and I. Obviously, we're also joined by Andrew McKenzie.
Pleasure. Great to join you, and thanks very much.
Fantastic. Got a bit of a delay. Will's in New Zealand, so things are a little bit behind in New Zealand, so it might take us a little while to get the rhythm of this going. We're also joined by Andrew McKenzie. Andrew is a senior financial advisor here at Kearney Group, an equity partner of the firm, and has been with us since he really started in financial advice. From what I recall, he seems like he's been here forever and is well known, I'm sure, to so many of you in the audience. Thank you both for joining. I'd like to kick off by acknowledging that I'm hosting here today on the lands of the Wiradjuri people. And I'd like to pay my respects to elders past and present. I'd also like to acknowledge at the outset for Ray Stagbauer, our compliance manager, that anything we talk about here today is general advice in nature only. It's not personal advice for any of our clients, but of course we'd love the opportunity to chat to you about your circumstances, whether it's Andrew or David or Paul or Kevin or Jeremy or Nya, to chat a little bit more about what's going on, what we talk about here today, and what's going on in your lives. With that, gentlemen, Will, you're the only person in this call at this stage that's actually living in a country that's officially in recession. How do you think that today's announcement from the RBA about Australian interest rates, how do you think that'll be reflected in the way in which the market responds? Sorry, not interest rates, inflation rates. How do you think it's going to be reflected in the way the market responds here in Australia? And what's the view in the New Zealand market about the current environment over there, and whether or not the change in inflation that we're seeing here will be reflected in New Zealand as well?
No, thank you. Yeah, no, good topic, which is one of the key focus for markets at the moment is, are we heading to recessions, bad recessions, early recessions, hard recessions? Start off with New Zealand. If New Zealand's in a recession, it's a very peculiar one, and I think it's probably not a bad sort of example of what may happen around the world. But basically, what's happening is certain cohorts are feeling it very tough, and a lot of cohorts of populations are not really anywhere near a recession, and that's really because the only area of weakness, the main area of weakness, is mortgage rates. So the people who are in a recession are doing it tough. Broadly, think 30-year-olds to 45-year-olds who might have bought their first home between 2020 and 22, or in a lot of cases, people are in the upgrading process. So when the mortgage rates went lower and they've got an expanding family, they use that as an opportunity to buy a bigger house. And most people upgrading tend to use most of the available leverage they can to do that. So those people are doing it tough, and that tough in Australia, that tough period really started to begin a few months ago when the fixed rates really rolled off and onto the high floating rates. In New Zealand, it's sort of been, we probably got there a little bit earlier, but not too much, and it's starting to cause, what we're seeing at the moment is discretionary retail in terms of clothes or durable goods are reporting pretty nasty downgrades. So whether it's furniture retailers or universal these companies have started, and particularly in May, as the February got, is that the sales really fell off a cliff. What we're not seeing at the moment in New Zealand or Australia or the US is a broad recession. By broad recession is, weakness beyond just certain retailers. Restaurants have generally been strong, services strong. There's still huge demand of outbound leisure travel, particularly the baby boom and older generation who, after COVID, had said, you know what, I might not get too many more cracks at traveling. I'm going to go and make the most of this and do a good trip. So, and what you've got is generally still pretty decent government fiscal expenditure programs around the world. So whether it's in Australia doing huge roading programs, New Zealand's running big budget deficits, the US is running big budget deficits. The government is helping prop up demand still. So what we are looking for, at Milford, is, and I'll go into the inflation in more detail perhaps on another question because there's a lot to unpack on that. So, but
sure.
What we're looking for is this recession or this weakness to broaden beyond certain durable good furniture retailers, clothing retailers. We are watching things like restaurant bookings and restaurant volumes very closely, travel closely, and we're looking for signs that tradies cannot find work. What thus far, there's no signs of weakness in those areas. Tradies who have lost work in residential construction are getting re-employed in government infrastructure type work, so they're still getting jobs. Restaurant bookings have started to falter in the last 2 weeks, but that may just be to do with school holidays and a lot of people traveling. So if that weakness sustains for 3-4 weeks, it's a bit of a red flag for us that the recession's close. But our sort of base case is the broadening of this weakness in Australia and other countries is still going to take a long time to play out, which may mean that we're not looking at rate cuts in early 2024 like many hope. But we've got to react to the data. We're going to watch it closely.
I did notice in a couple of recent market updates, the two large food retailers in Australia both commented on the fact that clients, I'm not sure what term they use, but clients are essentially trading down in the choices that they're making in their food consumption. They're eating at home more and they're buying, good for the retailers, more of the home brand style solutions. Is that something that you observe at Milford?
Yep, that's right. There is an element of that downgrading and people looking for cheaper ways to the cost of living. So if we dig into excluding mortgage rates and let's look at the cost of living pressures. Well, real wage growth in Australia at a broad level has just ticked positive again. So it finally maybe after being negative for quite some time, it's got positive again. But if we dive into it, there's certain again we're looking at cohorts. Certain cohorts who are struggling with the cost of living, wages versus the cost of living, and that's public servants in general have not had as much wage growth as inflation yet. It may catch up, but they've been lagging a bit. And think certain white collar kind of workers. But if you look at general blue collar, well, the wage growth has been quite strong there. Whether it's been tradies or general blue collar work. So those cohorts, you might have had a 20% increase of cost of living, but their wages are up 30%. So they're actually doing okay. And some retirees who aren't working but have elements of their money in cash and term deposits, of course, are now finally getting a return on that cash again and are probably in a relatively good position. So yeah, you're looking at trading down by those cohorts who are struggling, whether it's the white collar workers whose wages hasn't kept up, or whether it's public servants. Those people are doing it tough and trading down. And I'll talk about supermarkets at some point, but now that the market is in the process of market crowded into supermarkets post Silicon Valley crisis, getting ready for an imminent recession, the market ran away from banks, getting ready for this recession. We're now on the process of that positioning reversing, where the markets realize the recession hasn't occurred just yet, so they're selling their supermarkets and starting to move back into banks or retailers or something more cyclical. So we in general are just trying to do the opposite. So we did technically sell a lot of our supermarkets, but Woolworths is starting to go down most days, and as the market rotates away, population growth is 3% is great for supermarkets, and some of that trading down the supermarkets make a better margin on their own brand, cheaper products. So we're now in the process of accumulating supermarkets again because we do sort of structurally like them.
Yeah, fair enough. Before we move to a review of today's inflation information, Andrew, is what you've just heard from Will consistent with what you're observing with a number of our own client base and obviously the broader community that you operate in? Are we seeing people, certain pockets of society doing it tougher and others are still pretty comfortable?
Yeah, certainly. Particularly those people that have bought properties at the peak of the market and been very, very highly leveraged into those assets. They're in a process of working through how to manage their cash flow positions, and we have a lot of new clients coming to us wanting assistance in trying to manage through this stuff because they've realised now that they've got themselves into a little bit of a spot of bother and they need a bit of help getting out of that spot of bother. And to the point around certain sectors. Areas, particularly around residential construction, we're seeing some weakness in those areas. But interestingly, a lot of the cafes and those sorts of businesses that we look after are going really well, which seems to just be a bit of a shift in spending patterns and people wanting to, rather than necessarily go to really expensive restaurants and things like that, they're trading down to going out for brunches and lunches and those sorts of environments.
It is interesting the way you can simplify your life a little bit and still have things, a little bit tighter perhaps, but still make life feel like it's a really positive experience and that there's plenty of fun to be had. So will we get the opportunity now to turn our attention to today's, it being the 26th of July, today's RBA data, some positive information perhaps for the markets today with RBA releasing the quarterly rates and obviously the broader yearly number. Do you want to turn your attention to that?
That's right. So expectations for today was for inflation to be 1% quarter on quarter. It came in at 80 bips quarter on quarter, so 20 bips softer than expected. I mean, you caution a little bit. These data series tend to be a little bit volatile. So we've got to be a little bit careful of that. If the moderator can bring up slide 17, I'll just bring up an inflation chart of around the world. It shows the inflation in different regions. So the clear implication of this, and just looking at this in isolation, is that softer inflation means that this RBA may not have to do as many more rate hikes. So the general belief is that there's one or two more hikes to come, and we're on board with that. We think that's probably the most likely outcome here as well. This data doesn't mean there won't be any more hikes. Would still lean towards there at least being one more hike to come. Central banks are going to be wary that if they don't keep a little bit of pressure on, inflation comes back, and they don't want it to happen. But stepping back a little bit, what's generally happening is the US was one of the leaders of this inflation cycle, and they've actually seen their inflation roll over and moderate before most other regions in the world. So this data on this chart might be a month old, but the US inflation now is at a headline level getting down towards that 3% year on year, which I would call back within target. Targets may be more like 2%, but the reality is I don't think anyone's going to be displeased with 3% inflation. So if you can get back down to that level, I think you can sort of call victory for now on inflation. New Zealand and Australia, particularly Australia, was a bit of a laggard in inflation to take off. There's big enterprise bargaining wage agreements in Australia. That means the transition, huge public sector. The time for wages to take off in a lot of these big public sectors and some of the big banking sectors and so on just took a long time, and that's one of the contributing factors that inflation was slower to take off, but it probably, again, it'll be slower to roll over. So I suspect the most likely thing is that inflation does follow eventually the path in the United States, and both New Zealand and Australia, is that a little bit of the cooling of the economy through the rate hikes and simply just base effects and the durable good price and weakness means that our inflation does looking forward into next year moderate down towards that 3%. But the big question on everything, rates and inflation, is turning to what then? What happens in 2024? Do we get rate cuts or do rates stay on pause, and unless we see a broadening of this economic weakness beyond the cohorts that are weak, we think that we might struggle to see rate cuts next year. And if the market moves towards that kind of assumption, then longer term bond yields move a little bit higher and causes a little bit of a valuation pressure on equity markets. Not major, but just a little bit of pressure.
Yep. When we kicked off this process, as we tipped into the inflationary environment, obviously the central banks globally were dealing to a number of issues that were deeply suppressing growth. COVID was being a major part of it. We then came into the inflationary crunches caused by supply chain issues in food and energy, and just more broadly, the COVID supply chain crunch. In your mind, in Milford's mind, have those issues been addressed globally, systemically, or do they remain an issue and a risk as you think about inflation and more broadly demand around the world?
I will run through a series of quick slides because I think it tackles our broad things. If you flip to slide 2, we'll start there. But directly to answer your question first, yes, some of the issues have been addressed. The supply chain shortages, China massively ramped its manufacturing and other things. The supply eventually caught up to that excess demand during the lockdowns, and then of course that excess demand, everyone bought their TVs and their couches and other things, and we don't need more. So that excess demand cooled, and that part of inflation normalized, and even the shipping costs all normalized. And then you're sort of dealing with we had huge excess free checks basically given out, helicopter money, and that element is normalizing. So I think there's a pretty good case as we go through the echo of that, and the base effects, inflation does, cool off at that 2-3% for a period of time. We think the big idea is that we do still think we're in a 10-year period of structural inflation. If I quickly, I don't want to spend too long on this in the interest of time, but if we quickly touch off why, as we think it's these 3 factors here: decarbonisation, deglobalisation, demographics are huge. So decarbonisation, I don't need to talk about much. We know that, but there's an investment boom to happen. Building wind, solar, EVs, power lines, all of it. It's capex, it's investment, it's jobs, it's wages, it's inflationary. How inflationary, some estimates are 0.5% a year, but just think this is a gigantic investment boom in the Western world that we haven't seen for a long time. The Western world's done very little capex for many decades. At the same time, deglobalization is becoming more obvious, and that's basically COVID was the first warning shot about risks of supply chains. But really, it's the war in Ukraine and Russia just highlighting to everyone that you've got to be wary where your supply chains are and whether those nations are politically aligned with you. And what we're seeing now is the Western world. Apple is a great example, looking to put manufacturing in Vietnam, in particular, and India and Mexico away from China. So the incremental investment dollar is going to go to these other nations, and some of it will be onshore in the US. For example, we've got the strongest manufacturing capacity under construction in the US in decades at the moment. And it goes both ways. It's also, of course, China and the Russia and the other nations who don't trust the West. They're going to be looking to make sure that they've got their high-tech manufacturing on their own borders or with what they deem allies. So this is real. A good outcome is that during this whole process of China versus the US and the leadership, a good outcome is we just avoid war. But we think it's very unlikely you avoid an element of deglobalization. It's just the trust, no matter how much they can meet and hug and say, we had a good meeting. The reality is these deep-seated political, ideological differences, and they will never fully trust each other, and they'll be looking to secure supply chains. So this is inflationary because we're building new manufactories and we're moving some of the manufacturing away from cheaper cost countries. The third one, demographics, is basically in the Western world, we have more people approaching or going through retirement age than the ones coming into the workforce. So we've got more people aged between 60 and sort of 70 than we've got ones aged between 15 and 20. And that just means we've got shrinking natural working age population in the Western world. That means tighter labour markets, higher wages, higher inflation. Yes, immigration will be an offset to an extent, but we had last 30 years, we had a lot of immigration and very positive age demographics. Now we're going to have negative age demographics plus immigration. The marginal change is tighter markets, more inflation. So final chart before I hand back to you. Next chart, it says US inflation. If you just go one slide ahead. You know, we think, just generally thinking, the 1960s, 70s, nothing's going to be identical, but it's not a bad analog. Is that in a period of structural inflation, we'll have high inflation for the decade or longer, but there'll be waves. When we hike interest rates, slow the economy, you'll get periods of disinflation within this whole structure. And we're in one of those periods of disinflation now. But at some point, whether it's 24, likely in 24 at some point, but maybe 25, we think inflation will come roaring back. And then 2022 all over again. Rates up, markets down, bonds sell off. You know, at some point you want to be buying assets into that weakness ahead of the next period of cooling inflation.
So let me just play that back to you. I think what I heard you say is you expect no more than 1 or 2 rate rises over the course of the next 12 months. Inflation will come off, the economy will accelerate. Inflation, as a result of the structural issues you just identified, will roar back in again, and the central banks either here in Australia or globally will need to step back in to quell the market to get back to that standard 2 to 3% that is target for central banks around the world, really.
That's right, yeah, roughly thinking.
Well, with that by way of context and background, when we think about Andrew's clients, when we think about clients more broadly, what's Milford doing in thinking about how to structure portfolios to reflect that view of the world? What are you thinking in terms of where you go globally, in terms of your global opportunities, and what are you thinking about here in the Australian domestic market as you think about the absolute growth fund or your dynamic fund or your active growth funds?
Yep. No, that's right. The Milford has a lot of private clients in our New Zealand market, you know, like you're doing, and it's so we sort of do that full asset allocation as well. But generally, it's likely real returns are lower over the next decade or two than what we've enjoyed for the last 2 decades. So the last few decades, you know, let's look at US market or even largely Australia, you know, nominal equity index performance of 9% or so. Inflation's only been 2%. Real returns of 7%, compound 7% real returns for a couple of decades. Massive wealth creation. Happy days. You can gladly sit in a passive investment vehicle, an index fund, and you will be very pleased over the long term about the wealth creation. The next decade or so, if we're right on this inflation, and of course we may not be because we believe it's the likely scenario, but there's no certainties. You know, nominal index growth might be 6 or 7%, so still reasonable at a nominal level. But inflation may average 4 or 5, so you may only get 2, 3, 4% real returns. Again, not terrible. You still want to be in equities. You're still going to make money and compound wealth, but it won't be the great compounder of wealth of what we're seeing. So for us, what does that mean? It means that we want to really make sure that we're adding more value to our investors than just pure market beta or pure index beta. If the index is only going to give us 3% real returns, it's even more important than ever that we can add an additional 3 or 4% on top of that and still generate 6 or 7% real returns for our investors. And now, how do we do that? Well, first and foremost is stock picking. Very cliche, but it's true. If you've got a good team, a good process, you can add some value through stock picking. And Milford and a lot of our regions have been very good at that over time, and as are other managers. I'm sure you know of some who have good track records. So we think generally there's always a place for passive, and we don't advocate that no one should have passive. It's terrible. Get out of it. We're just saying if you're an investor that had a lot of passive and very little active managers, you may want to consider seeking out a little bit more active on this view. And then secondly, we can add a little bit of value with our asset allocation. So we think it's going to be a volatile period for markets, and not not that we believe you'll see these 50% type GFC market crashes that take 10 years to recover. But we think you'll see a lot of 20, 25, maybe even 30% corrections in markets, followed by aggressive rallies back. And that's because we're going to have shorter, faster economic and interest rate cycles. And markets always chase hard one way, like they're chasing the NASDAQ now, and everyone getting very overpositioned in technology stocks. But then it'll cause a washout the other way. And so, you know, we believe if you've got a strong top-down process, which a lot of managers don't, because they're generally pure stock pickers or pure bottom-up, but there are managers that do top-down and more macro as well. But we think if you can navigate this environment well, generally allocating a little bit away from certain stocks and sectors when they get overheated, going into whether it's cash or bonds or safer sectors, and then reversing that when the prices mean revert is another way you can add a % or two of alpha over this period. So Milford, if you look at our AA at the moment, more bonds than what we've had recently, because credit is actually pretty attractive. Equity risk premiums or implied equity risk premiums in equities are actually remarkably low and narrow. The capital stack is almost reversed, where you've got these fantastic sort of risk premiums on bonds. You can get, in some cases, 8 or 9% on quite reasonable credit risks and bonds. Yet that same stock will be trading at extremely high PE multiples or narrow implied kind of risk premiums. So in a lot of cases, you're far better off owning the debt than the equity in some companies. So for that reason, we're a bit underweight equities from normal. We've got more debt, and we're happy enough to hold a little bit of cash, and depending on the strategy, because you do get paid for a bit of cash. We think generally that's not a bad way to sum it up, is a bit more cash, a bit more bonds, a little bit less equities, and within equities, you know, we're just trying to avoid wherever it's crowding. As the market crowds into supermarkets or defences, we want to move a bit the other way. As the market now begins to crowd back into technology shares, we want to be looking to move the other way. There's a pain trade underway in banks, where everyone got caught underweight in banks, so the fund managers are hurting, and relative performance is suffering with this bank rally, and so they're chasing banks. You know, we bought a lot of banks the last couple of months. We'll start to let those go. You know, longer term, we like copper and lithium and energy transition and things exposed to real world growth. So that's the longer term holdings have sort of more aligned to this world of you know, real GDP growth being a bit better, commodities doing well.
So I want to turn our attention to Andrew, and coming to you in a second. After that, I want to turn our attention to back to those themes of decarbonisation, deglobalisation, and demographics, and how it's playing out in your SAA, and then Andrew, what we're thinking about in terms of the Kearney Group and the Ethos portfolios on that. To Andrew, did I hear correctly from Will some of the stuff that you think about? So active management at this stage, lower absolute returns over the forward estimates, but still looking to make sure, you know, the 3 to 4% real rate of return is achievable in this current environment. Is that what you're thinking about?
Yeah, absolutely, Matt. I think that's the age of just being able to sit in a passively managed fund and do really, really well is quite rapidly coming to an end, and they have done exceptionally well over the last decade. We've always held a view that having active management across the portfolios adds value, and we've maintained that view and think that we're probably coming into a position where that absolutely starts to pay off. I think the really important thing that's going to be essential to be addressed over the coming 3 to 5 years, potentially even earlier, is making sure you're really active in your allocations towards equities, towards bonds, and actually adjusting your tactical asset allocations over the course of the year. And this is one of the reasons a couple of years ago we set everything up in a managed account structure, so that if we do want to go and increase weightings to bonds or increase weightings to equities as is appropriate, it can be actioned really quickly on behalf of clients without it being a long, clunky process, which it can be if you're not operating under these sorts of structures.
Yeah, no, that makes perfect sense. With the proviso, A, not personal advice, and B, that data tells us that being well invested long term does substantially better than selling into the fear of a fall.
Absolutely.
Yeah, no, very good. Will, I noticed that Milford ethically aligned to Kearney's group position insofar as you're a signature to the UNPRI, Principles of Responsible Investing, and it appears that you're a member of the Responsible Investment Association of Australia. That takes us really nicely back to that decarbonisation theme, and Andrew, obviously some of what we talk about in terms of the ethos portfolio. Will, how are you finding access to, and how is the market responding to the opportunities to play into that decarbonisation play here in Australia and more broadly? Question one. Question two, do you think there's enough regulatory certainty here in the Australian market to allow investors to play really well or play really fully in this space yet?
Yeah, good question. I focus mostly on the Australian side, so I'll talk to that. Of course, globally, there's plenty of technology companies part of the solution, and we do, in our global strategies, own a number of these companies that are part of the solution. So, it's these heaps of technology involved, one that will enable this process. And for us in Australia, it's a bit trickier to find the real technology enablers, but of course, what we're rich in Australia is the metals that'll be part of the process. So for us, we love copper. We love copper over iron ore. I'm not saying I'm negative on iron ore necessarily, but iron ore is at the tail end of its glory days. It's China's demographics. The property constructions. China needs a third less properties per year than what they needed 4 or 5 years ago. It's over. And for us, copper, the structural growth in copper over the next decade is huge for this decarbonisation. So we like BHP structurally over Rio, because the BHP, particularly after Oz Minerals and with Olympic Dam, they got a lot of copper to come on. Unfortunately, in Australia, copper miners outside of that are becoming tough. Stanfire are 29 metals, but you can only own so much of those businesses because the stock-specific risk is just too high. So we've got to be careful. We own a bit of Stanfire, but I'm not going to put 4% of my portfolio in it. No way. What we can do is own a few international companies in our Australian Absolute Growth Fund. So we own Teck Resources at a 4% position, one of the premium global copper producers. We may add Freeport. There's some ESG concerns that we've got to check on. But so we expect us to own an old global copper miner to supplement that resource exposure. And that means we run a little bit underweight kind of the iron ore weights. We still take a big position in metals, but the metal weight will be very much more copper, less iron ore. And lithium, of course. So, lithium will just... It gets very hot and overheated. It's a very sexy sector and a lot of retail participation and chasing. So choosing our moments, but structurally we like lithium. We're picking a lot up early this year. We're letting a bit go over the last month or two when they ran a bit hot, but we're going to be in lithium and participating in it. Now, beyond those obvious plays, it's part of the solution. And one of the big solutions in the transition to renewables is going to be clean gas, or relatively clean gas. And again, Australia's rich in gas through our LNG. So one of our core positions is Santos. We think the world's going to be very careful from alienating carbon fuels too soon, and it became pretty obvious last year with the European energy crisis. If we don't produce a new gas production, and then all that happens is the world ends up burning more dirty coal to keep the lights on. So we need gas for the next 20 years. Santos, and this is where the regulatory certainty point you touched on is a bit frustrating. But Santos is trying to develop new fields and resources so it can meet an increased gas production profile. If all these projects they're trying to get completed, Santos will be on about a 25% free cash flow yield at only $75, $80 oil prices. Extremely cheap. The reality is one of two things will happen before it's on a 25% free cash flow yield. Either the share price will go up a lot above $10 a share, or it'll get taken over. Shell or someone will come and take it over. But but before then, they're struggling to get some of these fields developed because we've gone very anti-gas in Australia. I don't think the industry's done a good job of lobbying the importance globally to gas, and So obviously the Green Party very purely any carbon fuel is bad. So there's a little bit of regulatory uncertainty to get through. For us, if Santos can't develop these projects, then its capex goes down, it pays out all the money as dividends, and the free cash flow yield goes through the roof, and the stock does all right anyway.
You win either way in the play.
We're in either way, but there'd be a frustrating period in the meantime. So that's really us in a nutshell. So we don't ban carbon fuels at a banner. We won't invest in a carbon fuel company that's not doing anything to try and improve its own emissions or invest in cleaner fuels. Fortunately, companies like Santos and Woodside are gas rich. They're better than the oil rich Exxon Mobils and all the rest of them that are heavy oil and not much gas.
I did hear independent member for Warringah, Ali Stegel, quoted the other day. She was on one of the ABC channels, I think, talking about the fact that gas actually runs hotter than coal for the first 20 years. I have no basis for checking the facts of that, but it is an interesting political environment or political landscape for these relative technologies to prove their bona fides, if you will, both here in Australia and more globally as these very important issues get debated publicly and privately. Andrew, in terms of the ethos portfolios, how are we thinking about gaining access to the opportunities that this decarbonisation theme presents? In particular, managers we're thinking about, particular themes that you and Paul and David are leaning into?
Yeah, so the ethos portfolios run a pretty strict ESG overlay on them with a real focus on the environmental side of things. The reason for this focus is we actually view this as a key investment theme over the next 10, 15, 20 years. And every decade or so, you get an investment theme that comes up that you can get on board early and ride the wave. Like if you look back a decade ago, it was the rise of the consumer in China. Emerging market equities did really well off the back of it. We look at this now and we go, well, there's a key necessity for us to all transition towards a net zero carbon emission environment. This is going to be a huge driver of returns over the next decade or so. So we've integrated these themes across the entire portfolio. In terms of what it means that we have higher exposures to technologies that are around enabling the progress towards net zero. We end up underweight to energy, which started 2022. That caused some portfolio underperformance because oil markets rallied. But that's certainly started to reverse now as that's come out of the system. And we very actively allocate funds towards or monies towards managed funds or fund managers that are really focusing on being part of the solution and taking a very deep approach to how they manage their portfolios, as opposed to just saying that they don't invest in a particular asset class. We're looking for managers that are investing in solutions as opposed to just screening out specific stocks.
It's interesting, isn't it, how well-rounded or well-grounded long-term theses, whilst they might have relative performance challenges in various times or parts of the cycle in the marketplace, tend to win out over time. You've just got to stay the course. Be convinced in your theory and stay the course. And of course, have great managers like Milford you get the chance to work with to deliver on that outcome. So, gentlemen, cast our minds forward. It feels like, Will, am I right in understanding, in your view, inflation for the next couple of years, 2 to 3%, give or take some little bits of volatility, equity markets long and strong, but the ability required to be dynamic in your asset allocation? Am I summarising the view of yourself and your colleagues the right way there?
Yeah, roughly. I suspect before the end of next year, you've got a US inflation accelerating again. I wouldn't be surprised if it's as early as sort of mid next year, because the base effects are low. You've got oil prices rallying again, food prices starting to rally again. This sort of stuff are the early warning signs that maybe in the US we've gone through the best part of the moderating prices and we're in the very early stage of beginning the next phase of inflation coming up again. Australia lagging, so we'll probably be hitting that 3% inflation earning next year, and if we're to accelerating again, and maybe not into the latter part of next year. Equity markets, one of two things causes, as we sit today, not our base case on a 3-month view, but we don't rule it out that it doesn't occur on a 6-month view. So maybe that causes a setback. The other thing is, yes, if that inflation starts to rear its head, consistently over the next few months in the US, I think even beyond the US, that becomes a bit of a headwind for the market again, as people get a bit spooked that inflation may be coming back in that US market would flow through to problems everywhere in the world. But in the absence of that, agree. I think markets will be reasonably robust. I'm not sure they surge miles high ahead, but I think grinding higher, if you're in the right sectors, in the right companies, not a bad environment for making incremental gains and continuing to make a bit of progress on absolute returns.
And Andrew, your positioning as you look forward over the next 12 months, are we making any changes to the portfolio in terms of strategic asset allocation? Are there any big themes that you're running into that we should be thinking about?
The majority of the changes that we wanted to make have been made, which was really the reduction of some of the smaller companies' exposure that ran through the portfolios, just more interest rate sensitive sectors. So we've reduced some of the exposure there and increased exposure to the larger end of the market, where they're a bit more resilient to changing rate environment and so on and so forth. In terms of the overall asset allocation, we're not planning to make any further major changes at this stage. We'll watch it closely. The portfolios are set up for the scenario that Will really just described, which is continue to grind higher over the foreseeable years ahead. But we stand ready to adjust this if we get a big change in the macro environment.
And Andrew, without giving personal advice to any of our clients, we've really got two groups of clients, those who are still building their wealth and those who are using their wealth to fund a fantastic retirement. Would you have any messages for them as we conclude today? What should those in accumulation be thinking about, and what should those that are in that stage of life where they get the chance to draw down on the capital, the hard-earned capital they've earned, be thinking about?
Yeah, I think that the clients that are in that accumulation phase, there's always opportunities in markets. Those opportunities swing from sector to sector. We would be looking to ensure that people are continuing to just drip feed money into markets over the course of the years ahead. That will pay off over the long term. Those that are in drawdown or retirement phase, really making sure that you've got the right asset allocation. So there's a bucket of more defensive assets that sit in your portfolio, which you can draw on when share markets do react to changing inflation or rate environment, so that you're not forced to sell assets at an inappropriate time. And just looking to make sure that the portfolios you've got are generating a bit more of their return from income as opposed to capital growth, provides you with a bit more security and means that you can ride through market volatility with a bit more comfort.
Fantastic. Will, thank you so much for joining us. Congratulations on the birth of your third. Good luck over the next couple of months as that continues to play out at home. And can I say congratulations on the almost inevitable win by the All Blacks in the Bledisloe Cup on the Saturday night that's coming up. Really appreciate you taking the time to join us today, and thank you to yourself and to Chris for the great work you do with our clients. Andrew, as always, great to get the chance to chat. Thank you both, gentlemen.
Thanks, Matt.
Thanks, Matt.